Good morning, everybody, and welcome to the True Potential Do More With Your Money podcast. It is episode 51, and it is the 15th of January. Today, we're going to talk about how to do more with your money in 2021. A couple of top tips, a couple of different angles, and just some different ideas, which hopefully will help you save more often and invest towards your goals. Delighted to be joined this morning by Jamie Sexton, Steve Hutton, and also Jeff Casson. So good morning, gentlemen.
Nice morning.
Before we get into those tips, I think in time-honoured True Potential podcast tradition, Jeff, would you mind just kicking things off and recapping the last week, please?
Okay, thanks, Dan. Just for everybody looking back over the week in markets, what have we been seeing there? I think very much a story of what's been happening in the equity market and what's been happening in the bond market. We've seen equities sort of move sideways over the course of this week, given the strong move that we saw at the beginning of the year, primarily all driven by sort of last week and what happened in Georgia in terms of the election result. And that's continued to play through this week. Whilst at a broad index level, equities have kind of not really done a lot. It's been much more about looking in below that and thinking about what sectors have been doing well. And it's very much aligned with ongoing improvement in the economic environment. So those more cyclical sectors, the likes of financials, energies, industrials, have all continued to perform very well, along with small and mid caps, so those that are more sensitive to economic recovery. The other area within equities that's been doing well over the past week and over the course of the year to date as well has been what's been happening in Asia. So we've seen Japan continue to perform really well, up another 2.5% this week at the topics. Emerging markets up 3.6% this week as well. That's driven by they are typically more tied into global trade. Also, they're seeing a recovery in domestic activity there. So if we look at China, we're very strong in both exports and imports. So the imports continuing to improve, suggesting that domestic economy continues to remain pretty robust and continue to recover. Again, both economies probably, one would argue, slightly further through that recovery phase from COVID-19 and the impact that had on those economies earlier. I think the other thing that really we're looking at this week, and we touched on it to an extent last week, is just the movement that we're seeing in sovereign bond markets. And that's really important because that's the risk-free rate that we use for discounting any investment opportunity. And what we're seeing there is the US 10-year continuing to move up. So if we go back 6 months ago, you'd have heard us talking about the US 10-year being at 50 basis points. It touched 117 basis points at one point this week. So why is that occurring? Stimulus coming through and expectations of further stimulus in the US, with just Biden setting out his stall overnight, and he's looking for an additional 1.9 trillion of stimulus to be voted through the Senate and the House once he takes control. Good to see he'd be in control in a week's time, which should hopefully bring some political stability at least to the US. But to give everybody some context, I think it's funny that we throw out these big numbers, 1.9 trillion. What does that actually mean? What's the frame of reference that we can use to think about there? Well, actually, it's the size of a rather large economy. So if we think about that, it's the size of the Spanish economy, it's the size of the Australian economy, in additional stimulus that the US is wanting to put in. So you can see why markets are reacting and why the bond market's moving on the back of that. The reason the bond market is moving is what it means for inflation, and inflation picking up over the foreseeable future. That's something that you can't really forecast. We'll just have to take it as it comes and see how it evolves over the coming months, and something that we'll report back on. And I think really the other side of it over the course of the week is just what's been happening in commodity markets. Those industrial commodities, the likes of oil, iron ore, copper, have continued to perform relatively well, and those safer haven precious metals have really not done very much over the course of the week. Looking at currency markets, bit of sideways movement really there. Currency strength coming through from sterling up about 1% over the week. large part of that is due to sort of Andrew Bailey, the Bank of England governor, pushing back on some thoughts that we could see negative interest rates in the UK. So that has given a bit of a fillip to sterling over the course of the week. But I'll leave it there. Hopefully that's a run through, a canter through what's been happening in markets.
A controlled canter through, Jeff. Thank you. Just going back the 1.9 trillion side of things, Jeff. Just a question for hopefully which helps some of our listeners as well. When that money is raised, will that get put in the economy straight away, or do they tend to drip it in? How did central banks do that last year, for instance?
Yeah, so there's a couple of components to that 1.9 trillion that Biden set out, and I think one of the things that we have to think about is there's going to be a game of politics here. So he may be, starting high to be negotiated down a little bit, because whilst they do have control of the House and the Senate, it's a very, very slim majority. It's a majority of one. So there is going to have to be some give and take to get some of these things through. So high number to start with, but how that'll come through, what they did before Christmas was checks of $600 to everyone effectively in the working age population. His plan is to increase that to 2,000, so an additional 1,400 check, which could then be spent. So an immediate boost to the economy, provided that people don't save it. But if that comes through, people will spend it, and that will immediately go into the economy. There's another part of the package is very much more longer term, but focused on infrastructure and setting out a number of goals there, which will come through over a period of time. So that will take longer to come through. So there's an immediate hit, and then a hit that will come through further. From the central bank's perspective, one of the things that has been sort of in the market's view this week has just been, will the Fed continue to support the issuance that the government needs to make to fund that? Yeah. Very clear that they will. They will continue to employ quantitative easing and continue to buy back and to buy in those treasuries that are issued to allow that to occur. And that's something that is front and center of my mind. If I look back to 2013 and think about what was called the taper tantrum, then was when yields moved up from 1% to 3% in a very short period of time. That was all about miscommunication. And it's interesting just to see Fed governors over the past couple of days reinforce the importance of communication and clear communication with how they are going to manage that. So I don't expect that we'll see any pullback from what the Fed are doing. That'll allow that money to come into the economy and to support recovery.
And no more communication via Twitter, because Mr. Trump, he's only got 1 week left, but he's not allowed on Twitter anyway. So there'll be no more rows with the Fed on that.
1 week left, and I think just on that, that will be a good thing for markets. It's so unsettling for markets to get a tweet in the middle of the night as a relationship has changed. If we go back to 24 months ago, complete disdain for Jerome Powell at the Fed, and that wasn't well received. What have we got now? We've got the ex-head of the Fed, Janet Yellen, as US Treasury Secretary, and she will, I think, probably work pretty much hand in glove with Jerome Powell at the Fed at this point. So there should be a much better working relationship, but also an understanding as to how the Fed functions and how the Treasury functions alongside that.
Yeah, hopefully a quieter life anyway. Jamie, I'll hand across to you. Jeff was talking about, say, in the US with the stimulus package, with people getting, say, $2,000, and the hope being is that they'll start to spend that and they'll kickstart the economy rather than save it. If we look at, say, top tips for clients, me and you were just talking, I think it was just a couple of days ago, about spending the money or putting it, because you just received some money and it was like, should you spend it or should you put it in your savings pot? And you've got a savings pot that's linked to a goal. So could you just talk about the benefit of having a goal and the context that it gives you when you toss a coin between should I spend it or should I save it?
Yeah, I think, Dan, we're laughing because anyone in the True Potential family knows that, because I do a lot of demonstrations, that typically the goal on my website used to say Australia Fund, which is a plan to go to Australia for a few weeks one day. That's sadly changed since I had my little boy in September. It now says school fees.
It's been renamed, has it?
It's been renamed, so which was depressing. But actually, what was quite good, what I did was, and this is, I think I talk to clients about this in terms of saving. So in my head, I know that in 10 years' time, I need to have a certain pot of money. I actually even sadly went and actually worked out how much it would cost at this point and added some inflation on. So you understand exactly how much I need in 10 years' time. And then what was clever about that with the system, so in our technology, you can go in, set your goal. This is how many years, this is how much I need. You can put inflation on it if you want, which actually does help because the chances are it will slightly increase during that period. And the system does two things. It tells you how far you are behind. So if you're behind at this point, you could say, put whatever in for your impulse save and it'll get you back on track. Or it also does how much you could put in from a regular basis, from a direct debit basis, and how you can do that. So actually, by doing that, I found out I'm actually putting enough regulars in to ensure that I hit that as long as I continue to put that amount in, and I track it on a good basis. And I think when I speak to clients and I discuss about savings with them, it is really important that you do have an objective in line of actually what is that money for, because you need a destination. It's really important because I know when I check this, what I don't want to do is get to 10 years time and not have enough money. I think that's, I've got a long time to save, in my opinion. I'm sure it'll come quicker than I think, but I've got a long time to save. And by just looking at that, I'll be able to log on a daily or a monthly basis. I log on more than the norm. But just if I do need to put that little bit extra in, I can control it. And so I think it's vital. I think it's vital for you, especially, I'll give you an example of school fees there. But if we look at things such as your pension, in terms of your retirement fund, or even just saving for a rainy day, set a goal, set an objective, and try and hit that goal. It just makes life so much easier to understand why you actually are saving rather than just put some money away.
Yeah, so it's context, time, scale, amount.
Yeah,
I think,
exactly.
Yeah. If you're talking about time going fast, Jamie, with children, if you want time to slow down, just try homeschooling them. That's a way to just, well and truly slow your life down at the minute. So, I see Jeff laughing away. I think Jeff's suffering the same horror at the moment.
Between slowing your life down and slowing your internet connection down, it's a tremendous drain.
Yeah. I was on the line with an architect yesterday, and he had the video on, and he was showing me some different plans for some work we're doing in the office. And he just said 2 seconds, and he saw him running out of the room, and he started shouting at his lad. He must live at home with his lad, because his lad was watching Netflix in the middle of the day. And he'd say, "Stop watching Netflix! Your dad's on the phone." Another unforeseen horror. Steve, you're lucky because your lads have escaped the house, so you don't need to homeschool them. The two, or maybe you do, but they're hopefully old enough now to know better. Of course, like all children do. We talked a lot last year, Steve, and I know you did with clients, but also with the advisors who you work with and look after at Wealth Management, about staying invested and the importance of staying invested and then benefiting from the bounce back and from the kind of the positive, currents which are coming from Jeff. Does, apart from stay in the saddle or stay invested, how could you expand on that, please, for clients listening?
All right, thanks, Dan. Yeah, mine have all flown the coop, so I'm very sad. But equally, when I hear your tales of woe with the kids at home, I realise I've got through all that. We didn't have to homeschool them. I set up a savings goal to send mine to school in Australia, but this to school. That's a little different. Great point, Dan. And interesting, it harps back a little bit to Jeff's point about President Trump no longer being able to tweet. Let's hope we get some kind of reduced volatility in the market, because that's crucial to our clients. Because, as we've said before many times, when you watch the news at night, you only hear if the markets have done something which is bad, when they've actually gone backwards a little bit. They never, ever, ever, in all my lifetime, they've never corrected that by saying the day after, oh, markets have recovered today. So it can have a really caustic and detrimental effect on clients, mental health, if you like, because you're watching and you've got a goal like Jamie has, or you're saving for retirement, and the news at 10 comes on and some lovely newsreader says, oh, the markets have lost, 8% to not that much, but 5% today. It really freaks people out. And we really upped our communication to try and say to clients, stay in your seats and stay calm. The other way of doing it as well, and I think this is wise advice for everybody, including myself and everyone that's listening, is it often feels quite nervy if you invest a lump sum. If you invest a lump sum, say you put £10,000 in, you watch that £10,000, if you're a keen watcher, at the whim of the markets or the whim of the investment manager to a degree. If you invest little and often, so use pound cost averaging, but also use a direct debit, for example, but put little bits in often, it does help you. It kind of confuses you a little bit in the sense that, you're not watching one large amount of money invested go where the markets go. So I would say to everybody, and it's really crucial in this time. Let me give you another example. I'm having a dry January. That's why my voice has probably dropped an octave and I sound very miserable. I think if, like you guys, if I had kids at home, this is one task I couldn't do. I would try January, but
dry January lasted a couple of days, Steve.
Yeah. I did say to my wife, I said, I'm having a dry January. She said, well, I'm having a moist one. So she has a few drinks on a Saturday night, which I might join tomorrow. But money you save from things like that, you should contribute into a regular savings plan. Certainly for our younger clients, start saving as soon as you can, because as we see, the money you can put away as early as you can has much of a longer time to grow, and it becomes far more beneficial to you going along. So can't recommend that high enough. Use a direct debit if you don't think you've got the self-discipline to do it, and that's not a criticism of anybody. I'm lacking in a lot of areas of self-discipline, but just set up a direct debit, and I assure you, you won't notice it. As soon as you've been doing it for a couple of months, you won't even notice it's leaving your accounts. So little and often, and I'll come back on, I'm sure, later on, but I will not let up on using your tax allowances, because I've got a few ideas on that as well.
Yeah. No, I think that the direct debit's a great example, Steve, of good habit setting. If anybody has ever read a book called Atomic Habits, for instance, it's quite an interesting book, and it's how to set really good habits, how to avoid bad habits. So avoiding bad habits might be, for something like dry January, for instance, Steve, it would be having no alcohol in the house at all. Take it all out of the house, and if it's not there, you've actually then got to get in the car, drive to the shop to get it. So you're increasing friction all the way to remove that bad habit. But for good habit, it's making them as frictionless as possible. So direct debit, once it's set up, there's no friction there anymore, because you don't need to do anything. It just happens. As you say, it's you're automating a good habit, which in turn gives a good outcome from there. In terms of the kind of staying invested at the moment, I mean, maybe across to you, Jeff, for this one as well, just following on from Steve there. I detect at times, and I see some of this from clients, that it's almost a little bit of different nervousness now. So middle of last year, we had clients say not wanting to get out the market because it had dropped, say, X percent, and we were saying no, it'll come back, and it's still coming back, of course, but it's, if you look at the performance over the 12 months of last year, it was up. I think we're getting almost a different sentiment from some clients at the moment, which is it's good enough up now. It's kind of recovered. Is that now the good time to cash out or take some money back off the table? What would you say to that?
I think I would tie it back to both Jamie and Steve's points around the goals. If somebody's investing and saving for the longer term, you want to stay invested. You don't want to be taking your capital out of the market. You want to keep that market exposure. And I think the other crucial thing about that is the role of diversification. One might argue that in certain areas of a market that they may be toppy, but that's not what we're doing. We're investing across multi-assets, across equities, bonds, and geographies to provide our clients with that journey that allows them to achieve their goals. So whilst somebody might want to do that, I would always advise to think about your longer term goal. If you take the money off the table, what's your catalyst for getting it back into the market? And that is probably, to Steve's point, you take a lump sum out, you're then constantly challenging yourself mentally. Well, when do you get it in? When do you get it in? And typically, everybody finds it very difficult to market time. So what I would say there is that I would advise people not to do it, and to just keep yourself invested through the course of time, really focusing on your longer term goals, because that's ultimately what we're all doing. We're wanting to offer a return to an investor to achieve that longer term goal. So keep invested, focus on what you want to achieve.
Thanks, Jeff. So keeping invested, saving often, as Steve's saying, with Jamie setting some context and some goals in there as well. And Steve was talking about tax allowances, so I'll hand back to you in a couple of minutes' time, Steve. But Jamie, just to help our listeners, could you just talk about the 3 different primary accounts where people can invest in, please, and what the differences are?
Yeah, so you've got your standard one, which you'd see most people, that would be the first choice, would be your ISA, where you can save £20,000 per tax year, effectively tax-free. The gross tax-free. You can. It's also, from our point of view, which is, I think, it's a good thing to note, is the flexibility of it, in terms of, if you took £1,000 within that tax year, you can put that £1,000 back in that tax year and still maintain that allowance, which not all ISA providers facilitate. So a really good sort of starting block is getting, in terms of tax-free saving, you can't get any better than that. You then have your general investment account, which we would sort of abbreviate to GIA. It's effectively, if you go over your allowance and you're still looking to save into the markets and get the growth from it, you then pick your general investment account, and that growth is taxable at capital gains, but you're still saving. And when we talk to clients about this, so let's just say, for example, someone comes to me and asks for advice on £30,000. I may invest £20,000 in their ISA and £10,000 in the GIA, but the anticipation of the GIA is to filter that into the ISA over that period of time to get that benefit of tax-free savings. But definitely the best plan, especially if you're looking for regular savings, is the first one I would look at. And then finally, your pension. And this is, I want to say, most employees in the UK will have a workplace pension. It was mandatory by law in 2012, voter enrolment, and it's a great option if you're looking, for your retirement planning. You're getting tax relief. You find with employers, such as ourselves, a lot of employers do matching. So if you've got contributions that you're putting into your pension, if you check with your employer, if you increase it slightly, will your employer increase, and it just adds to that additional savings. Obviously, with a pension, you can't access it till you're 55, which is it's designed for that sort of retirement. But there's some really good tax efficient ideas within pensions. A lot of times when we come to retirement, with I speak to clients that have got maybe inheritance tax problems. You wouldn't necessarily draw the income from the pension for retirement, because it's effectively exempt from the estate and exempt from inheritance tax. So there's some definite benefits on that.
Thanks, Jamie. And Steve, you mentioned, linked with your direct debits and regular saving, about tax allowance from there. So could you just elaborate on that, please?
Yeah, a few points here. If you're lucky enough to be a high rate taxpayer, and don't forget, if you make a pension contribution, you will get a rebate of tax efficient. They will give you effectively an enhanced. That can be really useful if you've got other investments. Say you've got a buy to let or whatever. Buy to let, if you have one, everybody, you will realise that from this year you can't offset any interest payments against it. They're becoming less attractive to the investor, but equally you might run up a tax liability just on the income you're receiving from it. By contributing into your pension, for example, you can use the rebate you get from your pension to offset the tax liability you've incurred on your buy to let. So it really makes sure that if you're going to pay tax, make sure you're getting the other side of the bargain and getting all your tax rebates taken care of. The other issue is, and Jamie touched on it briefly there, is when you get to your goal fulfillment, it's very rare that a goal is actually a lump sum all-in-a-oneer. So stay invested, and if you need to use that pot to fund the goal, don't draw it out, put it in cash, and then fund it from a cash account. Because the point we've got to make here is inflation. And Jeff alluded to it with, okay, we might avert negative interest rates, but we're not going to avert interest rates that are really on the floor and next to nothing. So if you're in cash, you are losing money. So it seems counterintuitive to invest and save all your life or towards your goal, only to put it back in cash and start giving it away again and start losing money. So leave it invested. Leave a little bit of risk there on the table. It's only a tiny amount of risk because you put it into the savings accounts and you keep going, but leave it invested and only draw out the little bits that you need at the time. And make sure, self-employed people with January, etc., and we're all going to do our tax returns, we've had to do them. Make sure that if you're having to pay tax, then you're using your tax allowances to offset some of it, because it feels good for myself when I do it, that I get a little bit back from the tax man to offset some of the amount that I'm giving him. The tax.
Steve, it's worth saying as well with your pension, if you start to take income from your pension and your advisor set up a regular for you, so you're getting a regular income from that, after 12 months, have a look in your account. And if you're building up cash in your account, you're probably taking too much income out. And there's two benefits of being careful with this. Is one, you could be using, unnecessary tax-free cash that can be saving within your pension. But the second is you could be paying tax on that as well, which is unnecessary, which you can get growth on. So I would always say is after your 12 months, have a look at where you are. Are you building up cash in your account because you're taking too much out? And if you are, have a chat with your advisor and just slightly reduce it. It'll make a big difference to the growth of your pension over the long term.
I was just going to say the other thing that people can think about is we've got core funds, but we've also got income funds as well. And if you think about using the different mix between growth and income funds, then you can certainly take some income from those with the yield that they're generating and paying out. So there is other ways to think about getting income as well, based on how you want to invest from day one as well.
Just to stay on that point, please, Jeff. I think just again for our listeners, could you just spell out the difference between, say, the growth funds that we run and an income fund, please?
Yeah, so we've got our core range of funds that sit there, but we also have two income, a cautious and balanced income fund, where they do pay out regular income based on the income that's received from the investments. And where does that income come from? That income can come from dividends. It'll come from the coupon payments on bonds. It can come from the income that some of the alternative investments earn, and be they REITs, so real estate investment trusts, or they could be investment trusts that are exposed to certain areas of the property market, be that industrial, which we know retail's challenged, but industrial has been a really strong area of property markets, particularly anything tied into distribution, anything that's tied into data warehouses, given where we know the volume of data is going. So there have been areas in the marketplace where income can be earned. And if we think about the yield on those funds today, probably the income that one can receive, so 3.5% income coming in there. So that's the distinction. You can take that income, and that income can be either reinvested and just reinvested into your product, or you can take it off to the side and use it as well. So two ways to think about how one can get income. You can take it from the capital side, but you could also use income funds to generate some of that as well.
Thanks, Jeff. And that works really well, that concept with what Steve was saying, and indeed Jamie, which is, say, when you come to retirement or you hit your goal, rather than taking the whole capital out and just taking the cash from your bank, then maybe look to change strategy, go into an income fund and just get your investment account to drip the money out that way. We'll stay with you, Jeff, on this one as well. I mean, Jamie and Steve have been talking about ISAs, JIAs, pensions. With you as an individual, what do you look to invest in first? Do you use your pension allowance first, or do you do ISAs?
So I do both. So I think I use my pension allowance, I use my ISA allowance. I think, as Steve and Jamie have rightly said, it's important that we all do that, and we should try and do that as best we can. I think the other thing to add to that is using it for kids as well. So setting up a savings and regular savings plan for your kids, and that's, I suppose, if I think about my priorities, it's the pension, it's the ISA, and then it's for them.
You may not want to talk about your kids anymore because I can see your laddie looking through the door behind you.
That must mean homeschooling's not working
Yes.
right.
There he is. And Jamie, same question for you. Do you ISA first or pension, or do you try and have a balance like Jeff?
What I do is I look at, so rather than taking from my income into my pension, I just set my contributions higher on my salary, so I can pay into my pension, and then I pay. So I said I pay into both, and then I set a regular to my ISA, and I tend to think about, I start with what I want, sorry, what I need, and then I work back to say, right, can I afford to put that in? Yeah. And how much can I afford to put in at that point? So, for example, at the minute I've got a regular going into my ISA, up to my contributions on my pension, so which makes a big difference for that retirement pot. So I tend to use a mix. I like a bit more control, if I'm being honest. For the ISA, obviously I can access it and it's at my control. But that's why you kind of have to have some discipline with putting more into your pension. But it's interesting with the pension, as I said, with your contributions, most employers will look at a matching service, or even not. It makes a huge difference. Even putting an extra 1-2% in, if you pop on your website and have a look, sticking an extra 2% in over 35 years makes a huge difference. Yeah. Makes a really huge difference, and it's not so much of a difference to you right now. So it's worth just having a look and having a play with it.
Yeah, and I think Steve, final tip for today really, and I'm selecting you because you obviously, in normal days commute up to Newcastle, so you're spending money on fuel, spending money kind of, when you're in a hotel on the evening, or I know you also rented a house as well. So is it a case of still, Steve, looking to identify the savings you've been making from working from home and upping your regular savings?
Absolutely. For me, my goals now are all about income in retirement, which, is 20 years off, providing I work till I'm 80. Yeah, we've all, hopefully, on the that are listening, have got some spare cash that has not been used during this strange period. Don't waste it. I mean, there is the urge, obviously, to go online and shop, which I try to resist. I can't believe I've become a little bit of a shopper, because it's been my sort of pet hate for years, but now I've kind of done a bit of online shopping. As you'll see, I wear a natty different sort of top every time we're on. But back to the points on tax allowances. If you're unsure what your tax allowances are, obviously consult your advisor or give us a call at head office, because some tax allowances are the here and now, so your pensions and your ISAs, etc. But some of them have really valuable benefits further down the line when you get to your goal, which mine is now retirement, when I get to retirement. So hence I mix my ISA and my pension contributions, because once you contribute to an ISA, all right, you're contributing out of taxed income. But when you take the proceeds, that income is tax-free, which is invaluable when you get to using it. Equally with a pension, you have tax-free cash. But as Jamie said, don't forget, money that's in your pension pot is exempt from inheritance tax. And you think, I might not have an inheritance tax problem, but the way property prices have gone in the last few years, you might have one that you're not aware of. So make sure you're aware of what the tax allowances are now, but what they're going to be when you reach your goal and your plans come to fruition. And if you have got spare cash because we've been locked down in purgatory, then don't just flitter it away. Just get it into your goal planning. And by the way, guys, if you need me to help on homeschooling, I'm good on history, the history of Bradford City, because we won the FA Cup in 1911, beating Newcastle in a repeat. So there you go.
You can send me some notebooks. We've run out of notebooks here, so I've just lost my notebook for school.
Lost my homework. Yeah, I used to try that with Jeff a lot. Yeah.
I was going to ask you, Steve, if ITV did a good pension in this morning, but I was just wondering if that helped you.
That's a very in joke there, Jim. So I think we'll wrap up. I think Steve mentioned the depressing thing of being in lockdown purgatory, but Steve's buying his way out of purgatory. He's buying his way to happiness. Jeff, what are you up to this weekend? Are you going on Amazon and buying some notebooks?
I think that'll be the first order that might even have to be made now. So I've signed up to do. There's a charity that's raising money for MND, for Doddy Weir's charity. So they're doing a a January cycle, so I need to cycle a few miles inside, not in the snow. So I've signed myself up for 250 miles for January. So we'll need to get that moving on.
How many miles are you in? One?
No, I'm up at 75 at the moment, so we're not bad.
Just doing all right, taking away. I've seen that Doddy's doing that. He's also doing the sponsored walk, isn't he? I think it's like run or walk Doddy walk or something like that as well. So I've got a couple of pals where I live, a couple of ex-rugby players as well who are doing that right now and marching around Ponteland where I live with weights and things. Like one's a lad called Mike McCarthy who used to play for Ireland as a second row, so he knew Doddy via the Falcons and things. So yeah. Oh, well, good luck with that. Let us know how you get on with that as well, Jeff, and we'll try and get a link up at the end of the month once you've done your 250, and we can all donate from there. So and Steve, more sports tops getting bought?
Quite possibly. I've got the heady delight of, looking out the window now and it's thick with snow. Bradford City are at home tomorrow, and because I'm a season ticket holder, we get the free link to iFollow so I can watch it. But it's breaking my heart thinking I won't be able to watch them tomorrow, which I don't know if it's a good thing or a bad thing, because they've actually improved a little bit recently. But I was in lockdown in the room downstairs watching it on iFollow, which has to be on your laptop, and getting angry with them was not a heady mix. I can feel the pulse rate. I've got one of these watches like you've got, Dan, and I was watching my pulse rate go up and thinking, I'm sure this is not, it's counterintuitive, relaxing watching Bradford City. But if they play, I'll watch them. If not, I'm going to get some shopping done. So there you go.
Shopping done. And Jamie, I don't think we've got the pleasure of Newcastle playing this weekend, so that's good news. I don't think, anyway, unless you're going to depress me and say they are on.
I think I gave up on football about 2 years ago watching Newcastle. Actually, probably been longer. But no, I've just I've been doing shopping deliveries where I've got 30 cans of craft ale being delivered. So
so it's certainly not a dry January then.
It's not even a moist dry January, to be honest. But I can't resist a bargain. I'm one of these people where, if someone tells you it's 10% off, and even if it's not, I still tend to go for it. So that's that beer fridge behind us is getting filled. I did start dry January and lasted to the 7th of January, which I thought was pretty good.
I think anybody who can do it, and well done to you, Steve, for getting 15 days in. I think it's January, I always say, is such a dark, depressing month as it is. That's you need the little solace of a can of lager or a whiskey or whatever. So I've never done it. So well done to you, Steve. And don't make it a moist Saturday tomorrow, Steve. You can do it. Well, gentlemen, thank you so much. And ladies and gentlemen, thank you for listening. I hope you found it useful, some insights, some tips from 3 people and myself who actually do it. They're real tips, which hopefully you find useful. As always, please do like and subscribe to our YouTube channel. That way you'll get notifications whenever we publish new content on there as well, so you'll not miss out on anything. So have a lovely weekend, whatever you're choosing to do, ladies and gentlemen. Don't travel too far afield. Stay local, stay safe, stay shopping online, of course, and have a good weekend, and speak to you next week, everybody. Thanks. Cheerio.
Thanks, everyone.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.